Hey, this is Brent and Mike with another chart breakdown for trade therapy. We are breaking down SPY. Mike and I have been taking a look at SPY, following up on our Clarity spotlight last week on Meta. What you're looking at right now is our chart from October of 2023. If you've been keeping up with our content and or our videos, I believe yesterday in PayPal's video, I mentioned that a lot of the lows that have happened over the past couple of years have occurred in October. This is what it looked like in October of 2023. You see that SPY did not hold the 30-week simple moving average like in our textbook example in our graphic here. But what it did do is it held the edge of the creek. It did not fall back into the creek. If you recall, those of you that are studying Wyckoff, the creek is a concept where there's an imaginary line that connects the tops of the downtrend, and as it turns, there's a jump across the creek. So that's what this move is here. As it goes on and goes up and sets a sign of strength, it then falls back to the edge of the creek. So if you imagine this line continues forward right here, it backed up to the edge of the creek. So very interesting chart setup at the time. There was a lot of negativity out in the marketplace. Recognizing that as a backup to the edge of the creek move helped us to maintain all of our long positions. We took advantage of it and added to our long positions. This is the same SPY chart that we were just looking at. You can see that here's the edge of the creek, and here's the backup to the edge of the creek, and you can see the reaction that it had, that the S&P 500 had coming out of this low right here, October 2023, if you recall, probably only second to the October 2022 low in terms of all of the financial institutions, all the analysts coming out, screaming recession from the rooftops. Recognizing this as a backup to the edge of the creek allowed us to hold our long positions and, like I said, add to them. What was produced coming out of this low right here is what's called a lockout rally. Not surprising to see that that is the third wave of this initial 5-wave breakout structure that SPY is forming out of its post-COVID correctional period. Zooming in closer here, we do see some bearish divergence on, this is the relative strength index indicator across the bottom. This is a weekly chart. You see that we do have some bearish divergence or some negative divergence, even though this is flat, slightly tilted up. We do see divergence. That's not uncommon early in uptrends. We are just now getting to the 5th wave of the initial breakout structure. This wave 5 could continue on. A lot of people will see this and say that, oh no, wave 5 is here. There's going to be a recession or a big pullback right here. This wave 5 could go on for 5 years, 7 years. They could go as long as 10 years, 12 years, something like that. So don't feel like it's about to turn around and crash because we're on wave 5. It's not. We think that there's just some reaccumulation going on here. We do see bearish divergence, which sets up well. We think we may see an automatic reaction to the rate cuts that we're going to have tomorrow morning. If we do see that, we think that there's a chance that SPY will go up and hit its 1.618 Fibonacci level and potentially reject off of that. It's a little extended away at that point from the blue 200 weekly exponential moving average. Good setup for it to go up and make all-time highs and then come back down here in October seasonality, presidential election seasonality, and come down and test this low right here. So this rising 55-week exponential moving average right here, a red right here, I think makes for a good target at the end of October should we see the reaction go up and reject off of the 1618.
Right. Very helpful.